if I just laid out this one example, you'd see why I'm so big on everybody making their own way in trading. If you take me, I'm 20 years into retirement, multi-millions that I'm managing. I'm trading maybe at any one time 60 different positions across futures markets, global macro markets of all sorts of energies, metals, agricultural stuff. I've got ETFs across 30 sectors of the ETF market. I've got options spreading that I do for credit spreads in sideways markets. I've got stuff that's down to 3 days. I've got stuff out at 50 days in terms of parameters, 5 different indicators, 10 different strategies. Lots going on.
Right.
Well, I can do that in less than an hour a day. Some of it's automated, some of it isn't.
Mm-hmm.
Okay, so take Joe Smith out there listening to this podcast. Joe should ask himself, do I have Tom's knowledge of markets, risk management procedures, automation, knowledge of futures, currencies, and all these other things? How could what I'm doing ever be transferable over to Joe?
Mm-hmm.
Joe should design something for Joe that he can handle, he can execute flawlessly every day, that is appropriate for the capital that he's trading. If you've got, I started out with a $2,000 margin account when I got out of college.
Uh-huh.
And, so I appreciate the new trader starting out with, next to nothing. But you can't do what I'm doing with $2,000. You can't do it with 20. You can't even do it with 100 probably. So
Mm-hmm.
I think everybody's got to figure out which markets they want to play in and which ones they're going to deal with risk management in, how much automation do they want to throw into the puzzle. And it's a process that you just sort of gravitate throughout life. And where I am now in life, 20 years into retirement, I had to invent a lot of the stuff I'm doing today for me, for my retirement. It's not what I was doing at Trendstat. I had to create it to solve my current challenge, which is very different from me managing 600 million of other people's monies at Trendstat back in the day.
Yeah.
Different problem to solve, different challenges, different solution.
Mm-hmm.
So that's why I encourage people to understand. Now, are there some commonalities? Absolutely. I think everybody should have a buy-sell trigger. Don't sit here and just try to, I don't know, I feel good today, I think I'll go buy XYZ. That's not a very sound trigger to cause action. So I like to have indicators that measure the trend. When the trend shifts to the upside, I want to buy. When it shifts to the downside, I want to sell. I don't want to think about it when we have some kind of a trigger like that. Second thing I think people do a poor job of is position sizing.
Mm-hmm.
I know a lot of people will do some kind of risk management. They'll say, well, I'll take a 5% loss on this position. So they just go ahead and throw a 5% stop loss in there.
Mm-hmm.
That's not position sizing. That means you're just buying the same old position size that you always did and moving the stop around to compensate it. I think you should do the opposite of that. And I think we'll get into it a little bit more when we're talking about order of events. But to me, you've got to have a sound way. William O'Neill and the Investors Business Daily with their rankings, you're taking a way of taking a universe of thousands of issues and getting it down to ones that you might want to be interested in. That's all got to be part of a procedure if that's what your procedure is. And you need to follow those things. And you need ongoing monitoring. Just because you found a great stock and you bought it and you bought the right amount with your position sizing doesn't mean you get to go on vacation now. You have to watch it every day. You have to move your stops. You have to check your position size, because maybe, when you start out, maybe the stock was boring and you got into it and, all of a sudden it catches fire. It goes crazy. Well, now the risk has gotten super big. The volatility has gotten super big. It's dominating your portfolio. Instead of being a part of a portfolio, it is your portfolio. So you got to maybe back off of that position a little bit and keep it part of the portfolio. Take a little profit on it, keep the rest. Those types of thoughts and strategies could span any market that you trade, whether it's corn or gold or stocks.
Mm-hmm.
It's all
And so I just want to kind of understand your approach. And by the way, I'm just going to do a quick point out for those of you watching the video. I noticed this book myself over your left shoulder. That is by Van K. Tharp. It's The Definitive Guide to Position Sizing. Yeah, I mean, he was definitely known for really getting into the weeds in terms of, okay, let's talk about the math behind this stuff. So
yeah, that book is definitive is the definitive word. Really.
Yeah. So just to understand, you talked about how you were using Investors Business Daily, some of the rankings and stuff like that. At the end of the day, I feel like you were mentioning a lot of like 5-day, 50-day indicators. Are you strictly technical analysis, or what levels of analysis are you using to make your decisions in terms of your buys and stops?
Well, because I have leaned more towards ETFs and global macro markets, like the agriculturals and the softs and the metals and the all over the world. Because I've done that, I have a portfolio of tradable items that is somewhat fixed.
Mm-hmm.
Not all the time. There's new ones that come in, and I just added a couple. I just added a EFA index from the MS Morgan Stanley Composite Index from the EFA index futures,
Mm-hmm.
long and short in one of my strategies just 2 days ago.
Mm-hmm.
So stuff, it's always changing, and I'm adding things, and sometimes I'll take something out. But I think I don't really have so much the need anymore for screening stocks, because if the stock risk is any more that you can have a stock go up or down 10, 20% on the open, for retirement purposes, that's just a little bit too much corporate risk for me to have to deal with. Now, can I deal with it? Sure. I put together a portfolio of like 50 different things. I automate it. I try to bury that one stock's risk into a portfolio of things so that I don't get hit too hard or benefit too hard, even the other side of it, the reward side. I don't want my portfolio going up and down, 10% a day. That's retirement.
Yeah.
I just don't. So to me, I can pay the ETF manager a small amount of money, and he can put together a whole bunch of tech stocks. So rather than go buy, some tech stock or a portfolio of tech stocks, I could just go buy like XL Technology,
Mm-hmm.
a Spider,
XLK, right?
XLK or something like that. Or if I want an energy exposure, I can go buy XLE.
Mm-hmm.
I don't have to go buy Exxon and Shell and all the, Royal Dutch or whatever. It's just easier for me in retirement.
Yeah.
So again, I'm solving my problem, not solving somebody else's problem.